like to really welcome you in this webinar, and I'm really excited actually to have this special guest with us today. His name is Alex Spiroglou. He's a Greek fella as well. And I'm really, really excited about this webinar because Alex is an exceptional, not only as a trader, but also very interesting personality. Now, Alex, thank you so much for making us this honor to be on this webinar.
Thank you for the invitation, Theo. It's a real pleasure and an honor to be here with you.
Thank you so much. So just allow me to make a brief introduction and introduce you to our guest. By the way, guys, please use the chat to communicate with us here. And before we start, as usual, our risk warning, just to make it clear that this content is used only for education and general purposes, and under no point it considered as a personal advice or any kind of financial or business recommendation. And thank you so much for your understanding. Now, about Alex. Alex, it's a quasi-systematic across asset proprietary futures trader. His involvement with capital markets began ages ago, as you can read on the screen. Having worked for various proprietary trading and investment management firms in the UK and Greece, he's currently trading his own book. He will tell you himself more about that. And he's active in all major liquid future market across all major asset classes. That's equity, interest rates, commodities, foreign exchange. And of course, he's enjoying himself and his family with the most amazing cat in the world. And the name is Greco, and I'm not that surprised by the name, by the beautiful coast of Southeast England. Alex.
Theo, thank you so much for the introduction. And it's a pleasure to be here with you. And I hope we can have a chat that will be interesting to the audience.
Oh, absolutely. I'm sure about that. Just to keep something before we move on, there are people already asked, because, you know, in this webinar, we have traders that they maybe just started or they trade for 3, for 6 months, for 1 year. So they come from kind of different backgrounds. Yeah. So they ask what are the major liquid future markets, and if you explain us along the way the difference between equity, interest rates, and how do you trade them. Most of them are familiar on how to trade CFDs with the Forex. That's the pairs, the currency pairs, of course, and commodities like gold, like WTI, Cuber, and so on. Okay.
Absolutely.
And as for today's agenda, of course, we're going to spend most of the times interviewing Alex. Okay. He will explain us his approach, some major steps into his career, and we're going to leave some time at the end. Depends on the questions they're going to come in to answer, hopefully, all the questions. All right. So any question come in your mind, please instantly put them on the chat so I can collect them and understand how much time we're going to leave at the end to answer all your questions. All right, guys? And for now, that's all. So, Alex, let's start with saying first, I would like to say congratulations, because recently in 2022, if I'm correct, you won 2 awards, right? That about the MACD volatility normalized momentum.
Yes, absolutely.
Is that correct?
Mm-hmm.
Okay. Can you tell us a little bit more about this?
Yeah, sure. Well, basically in 2022, as you mentioned, I won 2 awards. One, the first one's the Charles Dow Award, administered by the Chartered Market Technicians Association.
Yes.
It's the largest technical analysis association globally, and they host a competition, if you will, for the best trading paper, research paper. And I think probably 20 or 25 people have won this award globally. And I submitted the paper to them called MACTV, Volatility Normalized Momentum. Basically, I took the MACTV and I made some new techniques and tools on it. And also submitted the paper to the National Association of Active Investment Managers. And I was awarded the Founders Award. So I won that award as well in 2002. So I think it was an interesting paper. Perhaps we can, go to more detail about it some other time.
Okay, absolutely. So, can someone apply your methodology and your strategy as a retail trader?
Oh yeah, absolutely. It can be. It can be because what I do, I try to keep it on a basis of being simple and systematic.
Okay.
My technique. Yes, my techniques came from the need to follow a procedure, to be rules based.
Okay.
So in order, I don't know. It's my mentality to have clarity, and I think this clarity helps you create discipline.
Yes.
And that was one of the main, basically have rules-based discipline. And that based on that discipline, I could also create a framework upon which to be repeatable, and about these repetitions to build confidence, because I've been having repetition-based confidence.
Awesome. So, is it true that we say, your opinion, when we say that the more systematic you are and the more structured plan you have on trading, pre-trading and while trading, when you have rules, the less emotional you become?
Yeah, absolutely. Because one of the benefits of being systematic, and let me clarify, when I say systematic, I don't necessarily mean fully automated.
Okay.
But because there is a wide range of how systematic it can be. One can, for example, make fully discretionary. One can be fully automated, or you can be somewhere in the middle, be semi-systematic or rules-based, such as I am, which means you have a framework of rules that you follow, and you can put some discretion around them in certain parts to it. So you can try to have ideally the best of two worlds. So to come back to your question, yes, I absolutely believe wholeheartedly that if you have a framework, a procedure, a blueprint, a set of rules to follow, the more chances of success you have. Because whatever you did, if you did it right, it can be reproduced, it can be repeatable. And
absolutely,
if it's wrong, then you can attribute it and say you can try to correct it. You can have processes, checklists, frameworks, and you can see that not just in trading, but also in businesses. For example, take McDonald's. I mean, if anyone tried to open a franchise or see how basically an operation like that, they give you a whole book. So that's the difference between if you and I try to open a burger restaurant or have a McDonald's. McDonald's would give us a set of procedures, checklists, how to do with personnel, how to do with the kitchen, how to do the servicing. So there would be a whole framework, a system. So that's why it was able to expand so much and be repeatable, because they would take their frameworks, which of course they would update and spread them across the world and, basically expand the business.
Wow. I love this paradigm you just gave, because at some point, traders, I believe they don't understand why they have to have a structured plan, at least as you describe it, a semi-systematic approach, and not just be discretionary. I mean, discretionary, it leads to a chaotic holding inside the markets. That's right.
Yep.
It's
Absolutely.
like
Absolutely.
you see the 1 hour time frame and it shows you an uptrend, and you see the 5 minute and it shows you a sideways. You see the 1 minute, it shows you a downtrend, and then they come and they say, oh, what's going on? What should I do? Is it an uptrend, a downtrend, a sideways? But based on your approach, you make it very clear that you are looking for specific things. That's right?
Yeah, that's true. That's true. And I think, to tell you the truth, one of the problems also today's, traders that to try to start is that they have too much information, and information is not knowledge.
Yes.
Because I had the pleasure of meeting and also talking with technicians, legendary technicians like Tom DeMark, John Bollinger, especially my friend Larry Williams. They lived in a different era. They had a different set of problems. Their problems at that time were there wasn't so much information out there. I mean, they even had to collect data themselves, create their own trading chart. So you have to be someone who really dedicated to proceed in this. Now we live in a different era, which a lot of people wouldn't even understand these problems, because you can go into, for example, an application sort of like the trading view and log in, and you've got all the data in the world, and then you go to the script section and you've got 5,000 indicators. But that also has created a problem, because you've got so much information, and it's like drinking off of a fire hose. And sometimes, as I jokingly say, and people nowadays suffer from trading ADHD. It's difficult to focus on their attention on one thing and learn what is most important, and also how to structure it in a step-by-step fashion.
Absolutely. I'm very very happy that you mentioned this thing. So if may I ask you, let's talk a little bit about your technical analysis. All right. So I was about to ask you that if you find technical analysis to be a significant part of your activity, or if you are also looking fundamentals and combine, can you just clarify a little bit about your technical analysis approach and how much of significant is in your trading activity?
Yes. Well, technical analysis is important, but it's only a part of the picture. And I say part of the picture because fundamentally it answers different questions than fundamental analysis.
Okay.
The technical analysis is more like the when. Fundamental analysis is more like the why.
Okay.
If you want to be putting it into very broad categories. So I do use technical analysis, but as a timing overlay. And I use macro analysis as a selection tool to give me a directional bias. So if I want to pick which market I want to trade, I need to know why I would be doing this. And that is purely a fundamental question, because trends, which of course we examine technically, but the underlying roots are fundamental.
Awesome.
I try to combine these in a rules-based framework.
Okay, awesome. Can you give us an example to make it more, let's say, more understandable? Because now that's what you said. I believe it's an answer to many questions that are supposed to come. So if you have something out of your head, can you give us just an example, or maybe a trade that you took recently or something?
Absolutely. Well, absolutely. Well, my whole the combination of technical and fundamental analysis. Well, what I try to do is I'm trying to give something that's a bit more evergreen, in the sense that rather than go say, okay, I'm a bit bearish of the S&P 500 or NASDAQ rather than this, which may or may not be correct, but also even if it is correct, it will last no more than a few days or weeks. What I'll try to do is patch my general framework, which I'm more than happy for people to keep. Well, my whole, basically it's a 12-step process.
Wow.
So if you want to be seeing it like a framework, so the bottom 4 steps of the process is my macro background. Now, the macro background is broken in 4 parts. It's my long-held belief that each time frame has its own return drivers. By that, I mean that each time frame has more of a dominant factor that influences it. For example, if you want to take an approach which is monthly, weekly, and daily chart, you will find that the factors that affect the monthly time frame are different than ones on the weekly and that's on the daily. So what I do, I start from the monthly chart, which I do what I call the business cycle. The business cycle can be approached either with economic indicators or with intermarket or cross-asset relationships. A gentleman who's created a very useful framework, so I tried to improve. I made a variation of it, was Martin Prink, which created a 6-stage framework for seeing where the business cycle is. Now, of course, that harkens upon the work of someone called Aries. That was probably almost a century ago. So that's the basic framework. You can also quantify economic indicators. For example, you can take inflation, do some mathematical, it doesn't have to do rigorous mathematical applications and see how much this affects the S&P 500 or equities in general, bond markets, commodities. And that gives you the big picture of where we are in the business cycle, in which stage. The second step is what I go into commitment of traders report. I'm not sure how many people are familiar with it. So just to go very briefly, basically commitment of traders report shows the amount of open interest that is open in each futures contract. And it breaks it down into what is called the commercials. Commercials basically are the companies that have use the commodity for business purposes, either because they produce it or they use it. For example, crude oil, commercials would go under the category of oil drilling companies, mining companies, or it can be in the sense of an airline company who uses fuel as its main part of doing business. And by analyzing, and also you've got another type of large trader, and also you've got the non-commercials, which are basically funds, which by and large are trend following in nature. Now, these are the mechanisms. You've got the small speculators. So these categories also help you to get the big picture, what the smart money is going. They won't tell you what each firm individually does, but collectively. Now, that's the second step. Of course, I don't want to be oversimplifying it. In each step, there are a lot of things to be said, but I'm just giving you the basic framework. The third step is going into sentiment, and that's a very, very big part of analysis, showing and you can use surveys or positions to see how much institutionals or retail investors are feeling and what positions they take, because at the extremes they usually are very loaded. And the fourth last step is seasonals and cycles. Now, these 4 tools help me create a macro picture for any type of market. It doesn't have to be that all 4 have to be bullish. Usually they're not. It may be that 2 are bullish, 1 is in the gray, and 1 is bearish. So that's what it becomes, an art rather than a science. But being rules-based, you go with the weight of the evidence. So that's my macro background. Also have a slide to share. I don't know if that would help.
Sure.
Let me try to screen sheet. Yes, that's the one. Can you see it?
Yes.
Perfect. All right. So that's my training plan, which also kind of like framed as a training path, what I call it, because I've started to be teaching it to others. So as we mentioned, at the bottom part is the business cycle. Can you see my cursor?
Yes.
Right. So the business cycle, then we proceed to the commitment of traders report, then we go to sentiment, and then seasonality. So that's my macro background. Again, each of these steps has to be rules based and with indicators, frameworks, checklists, and so on and so forth. Then I progress to the technicals, because once I've got the macro picture, then I have to go into the technicals. Now I've got the trend roadmap, basically seeing what the trend, market structure, pattern recognition, and so on and so forth. Basically the trend, if you want to liken the like a car, if you want to go, for example, moving from London to south, so from Southampton, you're going south. Obviously, if you're going to Manchester, you're going north. So the direction where the car is going is basically your trend, bullish or bearish. Then I go into momentum. With momentum, basically, is the speed that the car is using, because the car may be moving at this direction, but you're going 70 miles or we're going 50 miles. Yeah. Then I see volatility, which is a big part, because volatility, as my friend John Bollinger once said, low volatility is where trends are born, and high volatility is where they go to die. So it is a very, very good technical setup. And also, you can also use it for risk management. And the fourth is what I call the relative ranker. Basically, so if you've got two cars headed in the right direction, in one direction, for example, going from London to Manchester, they're going north. You may see their speed, but that's the momentum is the speedometer. The odometer is relative strength. So one may be halfway the distance, one may already have reached Manchester. So it's always good to see which market has traveled the furthest. And the last part is basically taking all this information and taking it into a trading setup, which is basically a trading plan, which is basically what I call the 4S framework: setup, signal, size, and stops. Because each trade is comprised of these 4 parts. No matter how you trade, is the setup, basically why you want to be going into this direction, bullish or bearish. The signal, where you actually physically get in, the size, and the stop. So that's my general framework.
Wow. I'll be very honest with you. There are so many questions. I read them on the other monitor I have on my left, and I see Arturo, Kaito, MM, Jose Leonardo, and all the rest. Guys, I read your questions, and at the end, we're going to try to answer every single one of them. Okay. By the way, there are many questions related to what you just described now, Alex. So we may need to come back to that pattern. That's the pattern. Okay. So would it be okay to ask you which markets are you trading? Like, we read at the description that you're trading all the liquid markets, but can we be a little bit more specific, maybe?
Yes. Well, basically, I look at equity futures, basically both European and US based, and also from the from Asia. FX, I primarily do European again and US, also UK as well. FX, the major crosses, whether in Europe or Australian, Canadian dollar, the commodity dollars. And last but not least, I also do commodities, again, the major ones, but gold, crude, or from the soy markets, from the soy complex, softs. These are all markets. These are about I think it's about 55 markets which are on my monitor.
Okay.
But the main, I think the main point to highlight is not so many how many markets are on my radar, but which I select. So the answer is, in which market I trade is actually the market that is set up, the market that is actually more fundamentally inclined to make a move, if that makes sense.
Okay.
Generally, my in order to partition, to have a better view of how the economy works, and also helps me in my economic framework, I've divided the economy of the markets on 10 different sectors, depending on which part of the economy they respond to. You got equities, you got bonds, Then you've got commodities like energy. Then you've got commodities like precious metals. You've got industrial metals. Then you've got FX. Then you've got commodities like agriculture. So in general, there can be 7. So with using the intermarket relationships, these can also help me pinpoint a market that will be trending.
Okay, awesome. That will be really interesting. Another time to make a webinar and purely see you, if you allow us to do that. So to show us on the chart, let's say how your setup and these rules apply, and you go through that analysis, the selection, and then the execution.
Yeah, of course. That would be a pleasure, and also see, the things I do right, the things I do wrong, and the mistakes I do, how I try to correct them, and so on and so forth.
Awesome. So thank you so much for the clarity. Now, a question: are you an intraday trader, or do you hold positions overnight? You mentioned something like some weeks.
No.
Can you please tell us?
Yeah, well, not my position. Well, I've got basically different strategies, but all of them are based on an end-of-day basis. I don't do any intraday trading.
Okay.
And I also don't trade individual shares. There are many reasons for it, but I think it's people are best, especially people who are just to begin, to stay away from intraday trading. Let me put it in terms of an analogy. Imagine someone who's learning how to trying to drive, and you put them in a NASCAR competition. And for those who may not relate to what NASCAR is, it's the driving competitions that you go, the cars go in the US go in a circle, or in the Ferrari one, if you people might relate, and you go going at such very fast speeds, and it really takes someone who is intensely focused and very competent to do that. So I try to advise people to stay away from intraday trading. Now, myself, I find that I'm much more productive, and it suits my personality as well, because I'm more analytical rather than reactive. So that's my strong suit. So as a character, it suits me much better to do end of day, because I've got time in the world to see my data, think about it again. And if not, I'll go rather than being reactive. So it doesn't suit my character very well. But there are probably much better traders on an intraday basis than me. I'm sure there are. But so I try to pick where my strong characteristics are as a personality are, stick with them, try to leverage them.
Okay, that's brilliant. That's brilliant, because I think, and we can discuss on that, many traders, they start trading and they think, and in my opinion, that's not the right mindset, but they think that intraday trading, it's going to create profits and help the account to accumulate faster.
Yeah, you get to, basically the idea with intraday trading is that you can spin the wheel more often. But the thing is, I mean, basically wealth is created by taking small positions and holding them for a larger time. Now, when I say larger, my usual holding time frame is anything from 3 to 5 days.
Okay.
So you can see it's short term. It is short term, but usually 3 to 4, maximum 5. Now, there are some other strategies. Of course, if it goes my way, I may hold for 10 to 15 days. But these are my sort of like my long-term positions. So you would classify me as a short-term trader, but not an intraday trader.
Okay.
The problem with intraday trading is you try to capitalize on the quick reinvestment of your profits, and that's the appeal of it. That you can, like I mentioned before, you can spin the wheel more often. But the issue is that you've got a host of problems, sort of like costs, noise, and so on and so forth. There are a lot of challenges with intraday trading. Plus, it gives people the illusion that because you can train on a smaller time frame, that you can keep your stops closer and thus have a trade more contracts or a bigger position if we're talking about CFDs.
Yes.
And that appeals to the wrong type of people, which is undercapitalized traders. So they say, we've got a small pot, I can't have big stops, so how can I make my stops smaller? I go to a smaller time frame because that will suit my portfolio. But you shouldn't be picking your time frame based on your portfolio, but rather your skill set.
Exactly. And I like when you make it clear that the way you approach the market, it's how it suits your personality and how you can. I think many traders, they make the mistake to try to fit themselves into the market instead of fit the market based on who they are as traders, as characters, and so on. I don't know if you agree with that.
Absolutely. No, I think you've hit the nail on the head. It's, well, basically, as part of your journey to learn and evolve, someone has to first do self-awareness. Actually, to tell you that there are five stages to trader development. I call this they form the acronym SMART. All right.
Okay.
So the first stage of trader, and it's an acronym. That's why I call the 5 SMART stage of trader development. The first stage is self-awareness.
Mm-hmm.
Right. So part of that self-awareness you have to is, realizing what it takes to learn and, things about your character and how this will come later on, part of the market.
Yep.
The second is market knowledge. So first is learning about yourself. Second is learning about markets. Markets, of course, technicals and fundamentals, what I've shown you before this learning path.
Yep.
The third one is called an action plan, basically taking these and forming it into a concrete process.
Mm-hmm.
The fourth stage, the R of the SMART, is repeat and review. And that is probably the most neglected part of the learning process.
I couldn't agree more with you on that.
Yeah, everyone is so focused on the wiggles and waggles of technical analysis, the new indicators, and I'm not saying it in a dismissive way, because myself, I've got a couple of awards having created a new indicator, but I'm just telling you that if you go past that, in order to reach a performance or high performance, however you want to call it, you have to go into learning how to repeat and review your own trades. And the fifth stage, which is actually the trading stage, and only then you become a trader. Now, most of the people that I have seen from the non-professional community hardly make it past stage 1 or stage 2, very, very, very rarely. So that's why you end up with what they call rule of 90. 90% of traders losing 90% of the money in 90 days.
Okay. Exactly. So let's go back to your trading setups and your trading. Let's use the leftover time, because I see many questions, and I think we will need about maybe 10 minutes to go through all these questions, if not more. So let's go back to your trading. All right. I have a question for you. Most of that it's been answered, but can you give us an example of what an ideal setup may look like, if it's easy for you to do it?
Yeah, absolutely. Absolutely. Yeah, we'd glad to.
Because I think that sorry to interrupt you, that many traders here, they based on the questions they ask, I realize they want to understand. Okay, I'll
visualize it. Basically, if I understand from where because you're reading the questions, obviously, I would assume they probably need to visualize it. And the good thing about technical analysis and markets is it's very visual. But unfortunately, since this is an interview, I haven't come prepared. Just the slide I've shown you.
Yes.
Well, basically, the ideal trade, for example. Okay, let me give an example. So I start off from the weekly chart, and I don't look at technical analysis at all. So take, for example, a market that is set up. For example, take like crude oil.
Okay.
Right now, all right? So what I would do is I would plot crude oil. Now there are, sorry to interrupt, there are two ways to do it. Either on an individual market basis, if you want to check a market, or have scanners that give you the criteria and check all markets. So let's take the first scenario where we check a market individually. So what I do is go to the weekly chart. All
yes.
Right? Of course, the first part is seeing the business cycle. Now, I go to the weekly chart and put all the commitment of traders report. And
okay.
Either the raw data of the commitment of traders report and also indicators. And from that, trying to understand whether there is commercial buying or commercial selling, and if it has reached a point where potentially it can start becoming too much. So, for example, crude oil, it's under heavy accumulation.
Yeah.
But that is not a timing tool. It's not something that I will use and say, okay, this is it, get in.
Yeah.
The second step is check the check, of course, my intermarket relationships, and all. Then the second step is to see sentiment. Now, is crude oil sentiment bearish enough to say that that it might warrant a reversal of the trend? Now, why is market sentiment so important? It is very important because if there is too much sentiment in one particular direction, it means that everyone is invested in this particular trend. Mm-hmm. And that makes it very susceptible to a reversal.
Yes, yes.
And also the fourth part is to see if historically the market is up to making a change in trend or a continuation of its existing trend this time of the year. By that, I mean seasonality. There are certain markets which are, of course, there are fundamental reasons behind it that have a proclivity to move in a particular direction during the year. I'll just start with the most well-known adage: selling may and go away with the stock market, which currently seeing is under pressure right now. But there are, more importantly, especially in natural resource markets, in commodity markets, and also in bond markets, and in FX, there are seasonal. So that's also another factor to look at. And so once I've done this, then I go into the technicals.
Okay.
All these I mentioned are purely on the weekly chart. Now I may check with the only exceptions, I may see that the seasonals on a daily chart as well, but I'm not doing any technical analysis at all. Of course, I'm using charts, but I'm using macro information.
Okay, so you don't plot your support, your resistance, or any type of patterns or candle lines on the weekly chart?
Not at this stage. Not at this stage. The first thing I want to check is my macro, because macros move trend. And what I want to be doing is aligning myself with a trend, with the smart money, the big picture. This is I think this the biggest thing one can do to help themselves regarding having good entries is aligning yourself with the trend from a technical point of view and also from a macro. And also help yourself with and then I'll come in with timing.
Okay, so after that, you go, I assume, to the daily chart to look for execution and technical analysis?
Yep, absolutely. Then I go into technical analysis. For example, if I see a market is fundamentally driven for a bullish move, then I will go to technicals and see what's the picture there. Now, the first thing I will see is what I call market structure. Market structure is a combination of trend and pattern recognition. Now, the trend itself has 8 distinct different stages.
Yep.
Because in each time frame, for example, take the daily chart, but you can do it on the intraday chart, monthly, it doesn't matter. So, for example, let's look at the daily chart.
Yep.
You've got long-term, medium, and short-term trends.
Yep.
All right. So if you do the combinations between these, you will find that you have 8 different combinations. So for example, the first part is when you've got long-term trend is up, medium trend is up, and short-term trend is down. The second is long-term trend up, medium trend up, and short-term trend also up. So if you do these combinations, you can get like a sine wave. And based on this, I can pigeonhole the market and say it's in stage 1, 2, 3, 4. Once I've done that, I try to see the patterns using swing charts. Now, they sometimes also referred by zigzag. The zigzag,
Okay.
when basically it's a way to isolate local maximum and minimum points and see
Okay.
do pattern recognition in these. There are a lot of ways to do it.
So you are using the line charts. Are you referring to the line charts?
Yes, exactly. So, for example, sometimes people call it a zigzag line, but these zigzags you can call pattern recognition for it. And I love talking about this, but I don't want to be going too many details. All right, let me put it another way. If you take the last 5 swing points, so you have a swing high, swing low, swing high, swing low. You take 5 different points. There is a finite number of combinations you can have. Now, this is based on the work of Art Merrill. There's a finite number of combinations you can have. Based on these combinations, you can start studying the performance of the market. So if it has a high, low, or it has a higher low, lower high. So there is a way you can actually study market structure, pattern structure, in a very quantified way. I'm not talking about Elliott waves. I'm not talking about Gartley patterns. I'm just, I'm talking about something that's very science-based.
Wow.
And once that's my market structure. Once I've got that, then I go to momentum. And my tool of choice is the MACDV. Like I mentioned, that I got the 2 awards for. And then I see momentum, whether the market basically is going fast, whether it's going slow. There are 8 stages in the momentum life cycle. Again, which means that everything is very systematic, very... if someone understands the methodology, which is not that difficult, the difficult part is applying it.
Yeah.
So it's not information, it's the implementation that is difficult. But this starting point is to give a framework. So I don't know how many participants there are in the webinar right now, but ideally, if everyone has studied, everyone should come up with the same different answer on what the market is doing.
Okay, that's really interesting. So it's like, if it's either it's there or not.
Yes, there are of course discretionary parts to it. Whether you will take the trade, whether it's because you can go into procedure what I call trade grade, and not all trades are created the same. For example, going back to the market structure, if for example the long-term trend is down, medium trend is down, then you see the short-term trend going up. That's a different risk profile of a trade than a trade that has long-term trend up, medium trend up, but short-term trend down. Basically, it's a retracement. So you may have good macro on both, but this is different because it's got the trend with it. So it has a different trade grade, to put it this way.
Okay, yep, understand. And just for people, maybe they are not familiar with the Dow theory, and when we talk about long-term, intermediate term, or near-term trend, can you clarify what sort of time horizon you consider?
Yes, that's a good question. Well, basically, each time frame has 3 different trends in it. And when I say trends, I don't mean 5-minute chart, 10-minute chart, or the hourly chart. Let's just focus on one particular time frame. That can be the 5-minute chart, or it can be the daily or the monthly. It doesn't really matter. So let's focus on my operative, the daily chart now.
Yep.
The daily chart, you can have short-term swings. You can have intermediate-term swings, which are comprised of short-term swings. And then you can have a long-term swing, which comprised both of the intermediate and the short term. So these are the long, intermediate, and short-term trends within this particular time frame. And you can take this structure and apply it to other time frames as well. But I'm just giving you the example of how it works in one particular time frame. Now, 3 time frames, 8 different combinations.
Yes, absolutely. It's really, really interesting what you described so far. And I'm sure in the next webinars, we're going to try to go through some chart analysis so you can show us a bit more of your trading setups. We have about 5 minutes left before we start with the question. So let's talk a little bit about smart trader systems. You are the owner of the smart trader system, right?
Yep, absolutely.
Can you let us know what is it about and how a retail trader can use it?
Yes, absolutely. Well, basically, I will be launching the service, the company, in a little while. But these techniques have been in existence for many years. Well, my primary focus will be institutional investors, but I will be also open to private investors as well. Now, smart trader systems, as I mentioned, to understand the name and what it actually means, smart is because it's an acronym from the 5 stages of trader development, and it focuses on training, support, and development. All right.
Okay.
But each of these has to be systematized. So the training has to come through a very particular training path, which I showed you before. The support also has to be systematized. There has to be structures and procedures in the terms of, for example, like trader drills, or it has to be Q&As, or it has to be, there are certain patterns that someone has to follow in order to progress from one module to the next. And the reason is I'm planning to launch it in this fashion is to prevent people from binge drinking like it's Netflix. So I'll watch the first step and then go to step number 3 because I've always wanted to learn about this. Step 9 seems also very interesting. No, it has to be learned in a particular order. Yeah. And of course, development is because once you've got that and then you go into live markets and then you try to gain some confidence over time, and I'm talking about probably more than a year after having learned the basics, you want to be adding tools to your enhancing your skill set. So basically, it's a lifelong learning process, as I see it. Even for myself, I consider myself a forever student of the market, and I'm always learning. I found a platform to share my the little things I know about markets.
Awesome. I will share on the chat box later your website so people can find you and see what this is about. Although we have to let people know that it's under development right now, so there are no information. It's just for their reference to keep it and come back to it when it's ready. So another question that maybe people are wondering. So how much time do you spend watching the markets and do this analysis? You said you have about 55 markets on your screen, and you choose, of course, which one you're gonna interact with based on how do they implement all these procedures. How much time does it takes you to go through on a daily basis to scan the markets and see if you can find your setups?
Good question. Well,
because someone listened to us now, maybe he thinks or she thinks that 24 hours it's not enough, because we don't use the charts to show the examples.
Yes, absolutely. No, well, basically what I have program screeners.
Okay.
So they can pinpoint me to do the most of the hard work for me. So once I've got a range of markets or patterns or setups that I have to look, then I go into these. So most of the day I spend it researching, either doing analyzing markets or trying to research new techniques. I can tell you that probably the smallest part of my day is actually trading, just trade entries. Because once I find something, I go into my broker and then insert my orders, which are usually limit buy, limit sell orders, and then market orders to get out. So the execution part is really, it doesn't take me more than a few minutes.
Okay. So usually you place limit orders, not stop orders, or to go on a breakout, or
So if it's usually it can be both. Sometimes it limits, sometimes it's stop orders, depending on the occasion.
Okay.
But what I can tell you is that it's usually I go out on a market order when it's time to get out.
Okay. Awesome. I think at this point, I will start asking you the questions. Guys, please write down the questions. We're going to spend some time, all the time left actually, to answer them. So, Arturo, good afternoon, Theo and Alex, ready to listen and ask questions. So, Alex, in the COT report, the non-commercials are the real smart money and trend followers? Question marks.
Well, non-commercials are basically the speculators, large speculators, because speculators come in either two forms, large small speculators or small speculators.
Yeah.
You and I would come in the category of small speculators. Large speculators are usually by and large trend following. So they do not follow, they follow trends. They don't do too much macro analysis. So I'm not sure if they can be classified smart in the sense that they have some kind of superior forecasting power, but they are smart in other ways, in the sense that they diversify across portfolio, across markets. They may diversify across time frames, so they have very smart position sizing, portfolio construction techniques. So their smartness in anyone else. So, but their trade entry is, I would say, sometimes it can be classified as ridiculously simple. It can be even something as simple as a moving average breakout. But how they do it is it's different. I mean, they at these levels they don't so much fuss about the entries, but so much the position management, portfolio construction, and so forth.
Awesome. Another question from Kaido. What kind of strategies would you recommend it for beginner trader? Which technical instruments? RSI, MACD, ATR, etc.
Right. There are
what kind of
parts of it? Yeah. Which kind of strategy would you recommend? Well, basically there are 4 types of strategies, what they call the 4R framework. And usually for beginners, in order to build capital, and more importantly, not just financial capital, but also emotional capital, I would recommend to start with strategies that have a higher probability of success. For example, something like trading pullbacks. Now, because that will help them both emotionally and financially. Now, different strategies have different risk-reward profiles. Coming back to the previous question, trying to tie it up with this one, trend following, which is not what non-commercial large traders do, has a completely different risk-reward to a someone who trades pullbacks. Trend following has a very low success rate, no more than 30, 35, 40% at the best. But when they catch a move, it goes really their way. I don't think a beginner or any retail trader can have the emotional capital to sustain being wrong 60 or 70% of the time. So they need something, a different strategy. Now, so I would suggest that someone starts with simple strategies like, trading pullbacks. But the important point is not just that someone would trade a simple strategy like that, but also to trade it on a demo account. I know this is not what people would like to hear, and some may dismiss it as not being the real thing. My reply to that would be, you get 80% of the experience with 0% of the risk.
Mm-hmm.
So it's not just what strategy to trade, but more importantly, how to trade it in the sense of a demo account. And of course, you also need someone to tell you what you did wrong. You may read it in a book, but page 58 will not tell you what you did wrong. You need the critical feedback.
Mm-hmm.
That would be my answer. And of course, also combine it with fundamentals and so on and so forth. Now, I think there was another question, which technical instruments?
Yes.
Right. Now, I think, to tell you the truth, the landscape of technical analysis, there are probably more indicators than traders.
Yeah.
The problem is how to correctly create, and I'll use a Greek word, a taxonomy or a classification of where each tool comes in. And that's where my MACDV came in, by observing at least as far as momentum is concerned, the indicators you use. So you have one indicator for trend, I use swing charts. For momentum, I use the MACDV and the histogram. For volatility, I have volatility valuation. I have my own set of tools. You can also use, of course, Bollinger Bands. You can use average to range. And then you've got also relative ranking. There are many tools to use. But the important thing is to understand is use one tool for each type of job you're doing. I see many chart analysts go like, oh, that's someone's loser, in the sense that they use the RSI, and then on top the stochastic oscillator, and then the CCI. Guys, they're all singing the same song. They're all saying the same thing. There's absolutely no difference in using one. Use just one and learn how to use it properly.
You know what? I'm sure the people, they're gonna have they're gonna give a gift to themselves, not only to be here, but to rewatch what you said on this webinar. And thank you so much for bringing so much value, because you speak from absolute experience and everyone can feel that. Okay, so that's
I just want to be, basically I want to be sharing what I have done. There's no, I don't lose anything by just sharing what I've learned, the little things I know about markets.
Guys, there are so many questions. Let's try to answer as many as possible. So let's move on. Very fast, where can we get the business cycle, sentiment, and seasonality data or charts? Thank you.
Well, I have created templates which I will be bringing onto TradingView very soon. So you have, or you can program them yourselves, of course, depending on the indicator. Commitment of Traders report, it's freely available. You can get it on the CFTC website. Business cycle, of course, it depends on how you define the business cycle. I've used a framework, pre-existing framework, which I've tried to improve. But to come back to your question, I will be bringing this through on TradingView. So that would be the short answer for that.
Awesome. So you're going to let us know here at Admirals, and we're going to pass it on to all of our clients.
Absolutely.
And so do you know, I know that's another question. So do you trade on TradingView or MetaTrader? ?
Well,
or in none of them?
None of them. Let's just put it this way, because I agree with none of them. I think TradingView it's a very good platform for charting. I don't use it for trade. I use a different platform. Admiral is also a very good broker, so I think it's a quite reputable and people can stick with it.
Okay, awesome. Thank you so much. How do you determine the strongest and the weakest asset class? Can you show us an example?
Yeah, relative strength. Yeah, there are many ways to do it. Each one has its pros and cons. You can use one way to use it, for example, to see what the strongest asset class. Okay, I'll give you a very innovative use of how you can use it. Not many people use it. I'm just saying the best, but one is, for example, because it's a very easily accessible tool. You can use the RSI. Use a setting of a very long-term one, like RSI 100. See which market has the highest trading. Another one would be, which I prefer is even much better, use a volatility normalized rate of change, which basically see what is the rate of change of a market in a particular time frame, say a rate of change like 250. And then normalize it by its volatility. Or you can use my own relative ranker, which I will bring in fourth, which tries to combine many pieces under one indicator. I hope I've given any of these three solutions that you can use. There are many more you can use. I mean, it's I think the main important thing is to stick with one and also learn its ins and outs.
Okay, because time really presses us, but Alex, honestly, these are very interesting questions. So let's see if we can answer all of them. Do you use smart money concept in your trading, and what do you think about this approach? Like the smart concept we see on the YouTube, like people, they come with order blocks and try to find the candlesticks.
Smart money concept, I'm not sure. Candlesticks, I do not use. I think they are very abused as a technique. It's basically, if you go back to the training path, it's at the top of it. Candlesticks come at the very top, which is an entry technique. It's not the setup technique. It's not something that will. It's just for signal generation. So I think people abuse candlesticks in the sense that, oh, this XYZ pattern has appeared. Can I, I'll take the trade just because. No, that's just telling you to go in, but you have to look at the underlying structure. If I understand the question correctly, because I'm not familiar with what is the definition of smart money concept. Maybe it is something that I know that goes by a different name.
Exactly. So pretty much the way they present it on the YouTube, as far as I investigated a little bit about this, is they use order blocks. Like there is an impulse, there is a trend, and they take the last candle prior to the trend, and let's say that's hides the highest amount of orders, and then they scale down to the time frames in 1 minute, 30 seconds, and so on, and try to find accurate entry points with tight stop.
Yeah, well, the thing is, if my advice with this one would be the same, I would use for my material as well. Test it.
Yep, exactly.
Trust but verify. So if you have a technique that you seem kind of makes logic, and I'm just telling from experience, a lot of things that I thought made logic, but they were practically useless. Test it. I think that's the best thing. You back test them basically, because A, you will learn if they work, and B, you will learn how well they work, and also in which market they work.
Yeah,
because you may have the same pattern, the same system, the same setup applied across each different market, and you will find that in some it works and some it doesn't, and some it works really well, and some it works in a mediocre way. So that's why I prefer the semi-systematic framework.
Okay.
So coming back to the smart money concept, back test it and see if it works. Don't take my word or anyone else's word.
Okay, awesome. So how many trades do you take on a weekly basis?
On a weekly, none. You weekly time frame or
not the weekly time frame?
No, right. Well, it depends on how many markets are set up. Usually I would say probably 2 or 3, sometimes 5, but I think that's it. I'm not hugely active because I really wait for the market to set up. So that would be the number of trades I took on a weekly basis.
What are the most, we have, I think, another 6 minutes left. What are the 4 or 5 most important intermarket ratios like PSY and TL equities and bonds?
That's a very interesting
We can
question.
answer it very fast because I want to go to more questions.
Yeah. Well, the 4 more interesting. I like that they framed it. Yeah, 4. All right. Well, it depends on which is the market in question, because different markets have different intermarket relations which are more prominent. For example, for gold, there are different intermarket relationships. So you have to look at the dollar a lot. Also, you have to look at real interest rates, which is inflation adjusted. That's not just nominal. That's also a very big return driver for gold. When these go negative, then you go gold, which is in a better position. So the question has to be kind of like rephrased, which are the 4 most important for which asset class, because they're not the same. You cannot use the same relationships to trade equities and bonds.
Okay. I hope, Arturo, that satisfies you.
I hope. I mean, for example, for let's just say, okay, let's pick equities. For equities, I would see the relationships of short-term interest rates. I would go into the yield curve, which is, long versus short. You can also look at intermarket relationships of various commodities, because these may also affect from an inflation point of view. You can look at sector rotation, because in the business cycle, because you got different market sectors in terms of like commodities going in the reflation side up until basically the market, the business cycle begins and then it ends. So you may have the market, as they say, move, but there is a lot of sector rotation going under the hood. So you can use these sectors and use them as intermarket ratios and see, some may move to different stages. For example, energy usually is a late stage market.
Awesome. Due to the time pressure, really, I will pick the last question. Guys, apologies if we don't answer your question, but we really appreciate that you have that enormous interest, and I'm sure Alex will be with us for more sessions, of course, more market analysis. So the last question, what will be a realistic daily or monthly target? Let's say that monthly target, because you are not an intraday trader, so we're not going to have a daily target, right? Let's say a monthly target as a percentage of a profit. For example, 5% of total capital profit in a month, 10%, 14% for a professional trader.
You mean from a performance point?
That's what I understand. Yeah, as a profit. So what will be the realistic monthly target in terms of percentage?
Well, my first target is not to lose my money. That's my first target.
Yeah.
Guys, I really don't have a target. I take what the market gives me. I may have targets on my individual trades, but performance-wise, I do not have target. I can tell you. Let me answer it a different way.
Maybe you go for 2-to-1 or 3-to-1, 1-to-1 while you trade.
So all right. So we're going on a trade by trade basis.
Yeah, because you said that to clarify monthly target, it's a bit it doesn't depend on the trader.
Yeah, all right. Let me put it away. So because there are 2 ways to interpret it. Your targets, like either on a performance basis at the end of the month. Okay, how much money you need to make? The question is, I really don't have to. My only target is that I don't lose my head, to keep my stops, and also my basically keep my risk management so I can live to fight another day. The more I make, the better it is. But the main point, that's what I focus on, risk management. So I really don't have say, okay, make 5, So because you may do more. If you're in a roll, what will you do? Stop trading. Actually, you don't want to do that. So if you come on a trade by trade basis, I tell you what I do not do. I do not go on the, oh, you should trade on a 1 to 3 basis. That's a myth, because you don't know how much the market move will be. So you have to adapt with the market. So okay, that's a big topic. So you place your stop, and there are different ways to exit, either based volatility based, or you can use a target, but it's not based on it's based on market action, market structure. It's not how much I would like to make. Exactly. I want to make 3 to 1. I want to make 2 to 1. The market doesn't have to go through. I mean, it might actually give me less. And plus this, because sometimes I see it with people on the chart say, okay, this is don't take a 3 to 1 trade. But okay, so how do you know the market will move there?
Exactly.
You calculate 3. How do you calculate 1? It's a bit of it's a myth. It's a very useful statistic, but not after the trade is closed. For instance, say, evaluate how much reward you had for your risk, but it's a post-mortem statistic. It's not something you can evaluate beforehand.
Okay. Also, I think at this point, we have to stop with the questions. Guys, if you want, and if you really, we didn't answer your questions, again, apologies for that due to time pressure, because we have another webinar start after this one in a few minutes. So what I will do, I will share on the chat right now Alex's website. It's www.alexspiroglou.com. You will see that the website is under construction, so be patient. I don't know, Alex, if it's there is a subscribe I can see here, so maybe they can subscribe and they can get information.
If they want to join, they become on the waiting list. I'm not going to be spamming or anyone like that.
Okay, awesome.
Basically, just get on the announcement list.
Okay, awesome. So, ladies and gentlemen, Alex, it was really a privilege and honor to have you on the webinar today. I'm sure every one of us found this extremely valuable and satisfied. Already very positive feedbacks from people they watched the webinar. Feel free to leave your comments after we stop the webinar. Of course, every feedback is anonymous, so don't worry about that. Now, again, one more time, Alex, really thank you so much for your time and for your valuable knowledge and information that you shared with us. And we will look forward to have you in another call with us as well.
Absolutely. Thank you so much, Theo, and also Admiral Markets. It was a pleasure, honor to be here. I enjoyed the questions, both from the audience and especially from you. And I hope I'll be seeing you around.
Absolutely, absolutely. So, ladies and gentlemen, from myself, from us here at Admirals, would like to wish you to have a lovely evening wherever you are in the world. And I will be looking forward to see you tomorrow on the live trading session at 7:30 GMT. Thank you so much and have a good night.
Thank you.
Bye-bye. Bye.